Hi everyone, it's Jack about another video, and today I'm going to be talking about Crocs stock. This is a business that's had an absolute rollercoaster of a year, a 52-week low of $66 and a 52-week high of $151. It's currently sat around 88. It's down 41.5% from its highs in April 2023. This is a business that I really like. I've recently just picked up a few shares in this business as it trades at reasonably low valuations. I want to talk about why I think this is an excellent business, why I think it is a buy going forward, and perhaps talk about some of the bear cases and why I don't believe these are significant downsides to owning this business. So let's get into it. First of all, this business on a revenue terms has had a massive period of growth since 2020 or so, and it's kind of cooling down at the minute. Still, year over year, in the last quarter, this business's revenue was up 12%. The real outstanding part of this business for me is the gross margins and operating margins. A 58% gross margin on an item of clothing is absolutely outstanding. That was up 630 basis points year over year, but it's typically over 50% and has been for a long time. Operating margin of just shy of 30% and an adjusted operating margin of 30.3% is absolutely outrageous for a business like this, in my opinion. That gave them a diluted earnings per share of $3.39. That's up 31% year over year. This is really the strength of this business. I'm quite happy to see revenues ticking up in the 0 to 10% range, but those gross margins for this business segment are just absolutely outstanding, showing what an excellent operator this business is. Before I get a bit deeper into it, on the surface I see a company that's grown its revenues at reasonable high single digit, mid-tens percentage with over 50% gross margin, around 30% operating margin. I would expect the PE probably in the 15-20 range. I'm currently looking at price to earnings on a trailing basis of around 8, on a forward basis of around 9. That's just offensively cheap as far as I'm concerned. It's an earnings yield of around 12%. Price to cash flow of 6.5, which is, compared to any company, is absolutely outrageously cheap. Compared to Crocs' own 5-year averages, that is far, far below where it has been. 5-year average around 17.3, currently at 6.5 for price to cash flow, compared to the index of around 15. Price to earnings on a trailing basis, the index around 21, 5-year average 22.9, so slight increase versus the market, 8.25 on a trailing basis. And even then, the 2018 numbers is very high, but still it's the lowest number for price to earnings on a trailing basis that Crocs had in a very long time. As suggested by the name of the company, the major source of revenue for this business is the Crocs brand, but it's no longer just exclusively the case. 26% of this business's revenue is from the Hey Dude brand, which is an acquisition a few years ago, and they have great diversification in terms of geography. While 69% of the revenue does come from North America, now 40% of Crocs brand trailing 12-month sales were from international markets, seeing great growth in Asia Pacific. So Europe, Middle East, Africa and Latin America accounts for 16% of the revenue, Asia Pacific 15%, but they are growing much quicker. Digital penetration wise, 38% of the sales are digital, and channel wise, 46% of the sales have been direct to consumer, which is absolutely key to increasing those gross margins. Wholesale was only 54%, and that balance is coming down with direct to consumer growing at a decent rate, which is exactly what we want to see. We're seeing this trend with Nike, with Lululemon, with many of these large retailers which Crocs are not competing with, but it's an easy comparison to make because Crocs is such a small market cap business at around $5 billion. As I mentioned, the encouraging revenue numbers in Europe, Middle East, Africa and Latin America is actually pretty weak, down 1.4% year over year. North America, the largest market, up 12.5%, and Asia Pacific absolutely blew the others out of the water, up 39% year over year in Q2, albeit off lower base. Q2 direct-to-consumer comparable sales growth, 40% for Asia Pacific, 13% for North America, and 39% for essentially the rest of the world. This is really impressive. What I want to see, this is going to be driving gross margins up, even in the face of inventory crisis many businesses have been in, and Crocs is no exception, has a large inventory position, but it still managed to have excellent gross margins because it is pushing those direct-to-consumer sales up even more. The major growth driver for this business is looking like it's going to be Asia Pacific in the long term. China revenues grew triple digits in the second quarter of 2023. Over the last few years, they've had 30% compound annual revenue growth across these regions in Asia Pacific, and this trend doesn't seem to be abating with an acceleration in the Q2 and the trailing 12 months results. This is absolutely key. North American is probably going to be reaching saturation very soon. the rest of the world seems like it's kind of reaching saturation, or the demand for this product is decreasing. As demand ramps up in Asia, it's going to be absolutely crucial that the business capitalises on this and tries to push direct to consumer. Inventory growth and large inventories on the balance sheet has been a consistent problem across many retail businesses. Nike, Lululemon, Walmart, Target all had a lot of excess inventory. Crocs is absolutely no exception. While they do brand this in the investor relations as a healthy inventory position, I'm not sure it's quite healthy yet, but it's definitely going in the right direction. There's been a 13% year-over-year decrease in inventory balance, but it's still around $436 million, of which the majority is Crocs, as you would expect. That Hey Dude portion of it, that is a very, very high amount of inventory for the amount of revenue they do every quarter. However, this is going in the right direction. I'm not so concerned about it going forward, as demand looks very strong, particularly in Asia Pacific. So while revenue growth wasn't what it was a few years ago, say, they're still predicting strong guidance going forward. They've upped from their prior guidance of total revenue, which is around 11 to 14% to 12.5 to 14.5%, which is a decent uplift, and that's mainly due to the guidance for Crocs revenue growth and a slight decrease in the Hey Dude revenue that they were expecting. They were expecting mid 20% guidance, and now it's going to be more like 14 to 18%. But Crocs has gone from 7 to 9 to 12 to 13, which matters way more to this business. Adjusted operating margin is expected to decrease slightly from where it was this quarter, but on average a 27.5% operating margin is absolutely outstanding. One-time cost effectively non-existent, and a little bit of capital expenditure not really relevant compared to the size of this business's market cap. While they maintained and actually increased some of their full-year guidances for the next quarter, guidance looks relatively weak. They're expecting total revenue growth of 3 to 5% compared with 12% year-over-year for the most recent quarter, and adjusted operating margin of 20%, which is kind of at the lower end we were expecting that to be. This is still absolutely fine as far as I'm concerned. I think the amount of risk baked into this business, there's a massive margin of safety, and I'm kind of expecting next to no revenue growth in this business just to be churning out some profit for the time being based on the valuation. I don't think that's going to happen. I think it's going to average high single-digit revenue growth going forward, and that's absolutely fine. As far as my thesis is concerned, I'm not expecting this to blow the doors off with revenue growth, but as a 30% adjusted operating margin, it doesn't have the best balance sheet in the world, and this has been widely acknowledged. It has generated easily enough profit to paying down this balance sheet, and it has been doing that over the previous 12 months, 24 months. As they continue to do that, they'll be able to probably reintroduce a dividend and eventually be able to buy back some shares and get the share down, whittled down. It's sitting on a market cap around $5.4 billion right now. I think this business could be a $10 billion market cap, a $15 billion market cap company in the next 2 or 3 years if they continue on this track. That's really the thesis for me. I think it's not a perfect business. I think demand could possibly fluctuate. However, I see demand only really going in one direction. Fashion trends are murky waters sometimes, but I believe in this business. I believe in the strategy. And at a price-to-earnings ratio of 7 or 8, I think there is more than enough margin of safety baked in here. They have a ton of cash flow coming in. They're working down the balance sheet, which I admit is probably the biggest bear case here, is the balance sheet is pretty murky. However, I believe there's enough margin of safety baked in to allow me to invest in this business, even if it's just a small position. And at $5 billion market cap, like I said, I could easily see this business doubling in the next 2 to 3 years, no problem. Even if it just get back to its 52-week highs, it was basically doubled. While that is no easy feat, it was only 6 months ago. So that's my thesis for this business. Let me know what you think in the comments down below. Of course, I'm not an investment advisor, I'm not a financial advisor, so you should take none of this as financial advice. You should do your own research and due diligence and not just be informed about a stock because of what I say. Do your own research and due diligence, form your own opinions, and let me know in the comments down below. Like and subscribe and enjoy the video. I'll see you again next time.